From our studios in Scottsdale, Arizona, welcome back. This is Retirement News Online, where we talk about retirement. And one of the elements of retirement that is most important is income planning. And I think a lot of people, a lot of consumers, when they think of income planning, they don't really have a plan. They have sort of a drawer full of statements. And probably because they're conditioned to accumulate and try to hit a number, but there's the other side of that. Accumulating is one side, there's the distribution side. So it's important to think about income probably as a primary focus in retirement, because we're all living longer. That's the good news, but the bad news is we have to pay for it. Joining me is Ben Fuller. He's with Lighthouse Financial in Rogers, Arkansas. Would you agree that when you meet somebody for the first time and start working with them, and even if they're getting ready to retire, right, and we start talking about income, they don't really have a plan in place, do they? They just have this, they got assets, and it's a number that they've hit, and they've just got a drawer full of statements, so they're not really planning, they're just sort of hoping it works out, right?
Yeah, right. I would say that is correct, more so than not. And I think that's, at the end of the day, people think the industry has done a very good job of saying, well, you need this big number, you know, whatever that number is to retire. But at the end of the day, right, we need to know how much we need every month. Expenses play a bigger role. Very few people, right, when in our working careers, we want to just say we can spend because we have the money. We can go make more. The reality is more people, no one has a clue how much they spend anymore on a monthly basis.
Yeah.
So we focus a lot on, hey, let's determine how much you truly need a month. And then, do you have enough assets to last till you're 90, 100 years old?
Right.
That's the biggest concern I think that's facing any retiree today is, what is my longevity? Hasn't been the case, right? We always knew as 76 for a woman up until really the last 10 years, the advancement of medications and technology, things of that nature is creating, right, greater length of longevity. So now we're needing our dollars to stretch longer.
Right. And I think to your point, the data tells us now that if you are 68 years old and you're healthy, in other words, there's no chronic conditions that could be life-threatening or anything like that, your likely lifespan now is 92. And that's interesting, because that's a long time. When we talk about Social Security, when that was developed in the 30s, lifespan was 58. Man, the government made out like a bandit. They really did, which is probably why that Social Security is still here. But let's talk about some other clients. So the average consumer, you know, income planning is very important, and also the wealthier client, where they have enough money essentially that they're probably not going to run out, but cash flow can be enhanced by good tax planning. Right, 100%. And that's the most important part, right? Absolutely.
Yeah, too many times, right, when people walk in the door, one of the first questions I've always asked is, what tax bracket are you in? Right, I'm in the highest tax bracket. Well, I know they're not, right, based on strictly on their income. But it's a mentality that, right, that is built up just because no one enjoys paying taxes. They just assume they're paying the most. What we have found is that our key goal is to reduce the amount of taxes you're going to pay during your retirement years. We can reduce the amount of taxes you're going to pay. One of three things are going to happen. You're either going to live a greater lifestyle during retirement, you're going to retire earlier, or you're going to leave a greater legacy to those left behind. All three of those are better than writing Uncle Sam a check, right? So tax planning is, in my opinion, the most overlooked area of retirement, because it's what I call, it's a drain, right? I'm pulling money out of accounts to pay Uncle Sam, therefore that money's not in my account that has the ability to compound for the next 30 years. So if even I can save $3,000 or $4,000 on taxes, compound that over 30 years, now I've left a greater legacy.
Right.
So very overlooked. It's actually think about your investment accounts. Your investment accounts you do, right, every year. If you don't sell anything in your investment accounts, then you don't have a realized return. You have a realized return in taxes every year, and it's always negative, right? So if we can reduce that number, then your real return goes up.
You know, and I think we're talking about the government, you know, and they always, I guess we're always led to believe that they got our best interest, you know, but I was looking at this year's COLA and Social Security, and you know, thinking about it, I know that the government, part of the calculation is can we give them an extra $2 or 2 basis points? And will that increase people's tax brackets enough in certain segments where we can actually get some more revenue coming back? I'm sure that's part of the calculation at some point. So the government always wants to get paid back, and we look at RMDs, we look at age 73. I don't think a lot of people realize those things increase, every year, and that's kind of an eye-opener for people. So, let's talk about RMDs where they don't need the money, but they have to take it, and they have to pay taxes every year. How do you manage that?
Yeah, it's great. It can be difficult, right? The boomer generation has accumulated more of their wealth in qualified assets, so IRAs, 401ks, than any other asset class. Well, they were taught, right? They're also the first generation of the 401k.
Right.
Right? But they were taught that I want to reduce my taxes today. Well, we know based on history, we're in fairly low tax brackets today.
Mm-hmm.
People forget we were at 50% highest tax bracket in the Reagan years. So the high likelihood the taxes are going to be going up from here, and you've got an asset class with trillions of dollars in it that are going to be taxed at a higher tax bracket. The misnomer, right, has always been, I'm going to pay less taxes in retirement. It's not true. First and foremost, your standard of living isn't going to change on December 31st till January 1 when you're retired. You're still going to want to maintain the same standardized living. That all comes back from my grandparents' generation when they were all on pensions.
Right.
Right? Your pension was 60% of whatever your 3 highest years of income. They had to live. That's all they had. They didn't have 401ks. So with regards to required minimum distributions, there are lots of strategies you can employ, right? But what we want to do is get as much money out of there as we possibly can in a tax favorable way, because not only is it going to impact you because your taxes are going up because it's more money than you need, but it's also going to hinder, with the new laws enacted several years ago, on how your beneficiaries of your IRAs are going to have to take those distributions. Mm-hmm. Used to, it was stretched for their life. Now it's a 10-year period.
Right.
You just created a tax burden for your heirs.
Right.
So definitely something that needs to be addressed today.
We need to spend some more time talking about estate planning and legacy planning too. We don't have enough time because that's a whole nother oyster.
Absolutely.
He's Ben Fuller with Lighthouse Financial in Rogers, Texas. Ben, thank you so much. And this is Retirement News Online. Thank you for watching.